So I'm, in the interest of time, even though I know we're going to have people continuing to come in, I'm going to go ahead and get started. First of all, for those of you who are coming from far away, welcome to Columbia and the School of International and Public Affairs. My name is Trish Mosser. I am the director of the MPA program in Economic Policy Management, but I'm also a director, probably more relevant for this event, of the school's initiative on central banking and financial policy. It's been 10 years since the worst of the financial panic portion of the Great Financial Crisis and the Great Recession. And that was the time that sort of, shall we say, thrust central bankers from their more traditional roles as somewhat boring technocrats into positions of a lot more importance and visibility on the front lines, so to speak, of crisis management and macroeconomic policy. Nowhere has that been more the case than in Europe, and in the Euro area in particular. And so that's why it's very, very good that we're here today to talk about Francesco Papadia's new book, Central Banking in Turbulent Times, which gives his perspective both on the financial crisis of 10 years ago, as well as the European bank sovereign crisis that followed it. Francesco, who was a longtime colleague of mine when I was at the Federal Reserve, retired as the Director General of Market Operations at the European Central Bank in 2012. He's a senior fellow now at Bruegel. He is literally a designer of the monetary framework of the ECB. He stood up the system, and he steered monetary policy operations from the very beginning of the European Central Bank through some of its very toughest times. We have a really great group of 3 commenters today to talk about the book as well. So we're actually going to do things a little differently and a little backwards from normal. With Francesco's permission, the commenters are actually going to speak first about their impressions of the book, as well as reflections upon the crisis, particularly focusing on financial stability, monetary policy, and the interaction between those two. After their comments, then Francesco is going to react, as well as, I assume, offer a few additional remarks about important points from his book. And of course, we'll have time for Q&A from everybody here on the floor. Finally, for anybody who'd actually like to buy a copy of the book, the bookstore will be available out in the lobby afterwards, and they'll have copies of the book there. So, without further ado, let me start with the first commenter, Bill Dudley, who I don't think probably needs much of an introduction. Bill was the president of the Federal Reserve Bank of New York and the vice chair of the Federal Open Market Committee from 2009 through this past June. But before he was president, Bill actually led the markets group at the New York Fed and effectively had almost the same job as Francesco. And so he knows what that's like. I won't give long introductions to all of these folks since they have wonderful resumes. Bill, the floor is yours.
All right, thanks. Well, I certainly always enjoy coming up to Columbia. I was a freshman at Columbia in 1970, a long time ago, so that tells you how old I am. It's great to have the opportunity to make some comments on Francesco and Tuomas Valimaki's new book. I think it's a great book. I find it very accessible and also very insightful in examining the challenges that face the New York Fed and the ECB, not just during the financial crisis, but in its aftermath. And in general, I agreed with the basic tenets of the book. The basic central banking model was found to be very greatly challenged by the financial crisis. And I think, in particular, the importance of financial stability came to the fore. The old notion before the financial crisis was, well, we let bubbles happen, they'll burst, and then we'll clean up after the fact. And I think that orthodoxy really got shown to be very inadequate. And as the book also points out, it's not clear yet we've actually found a more viable model to replace. We know we don't like the old model, but it's not clear we necessarily have a viable model yet in place to replace it. So in my remarks today, I thought rather than speak to all the areas of agreement, I thought I would speak to a few points where it would encourage further work or greater elaboration. So the first point I want to make is with respect to the monetary policy framework. In other words, how the central bank actually conducts monetary policy. To me, financial stability considerations point for a strong justification for the Federal Reserve to continue with the current floor-type system rather than going back to a quarter system, and I'll return to that in a little bit. The second point I want to talk about is that the risk, in the book, Francesco and Tuomas talk a lot about this model of good versus bad equilibria. And I guess I think that's a good model, and I like that model. But I think that in the book, maybe it's a little bit too much driven by luck or by the central bank's choices. And I think that prudential regulation also, I think, has a very, very important role to play in determining whether you end up at a good equilibria or a bad equilibria. Because firms on their own will not often decide not to hold the requisite amounts of capital and liquidity that are good for the system as a whole. Best case in point is the summer of 2008 when Lehman Brothers probably could have raised capital, but they didn't like the price at which they could raise capital, so they didn't raise capital, and we know how that all turned out. Third point I want to talk about is moral hazard. I'm a little bit less concerned, I think, than the authors about moral hazard. I don't think that's a good reason to not act aggressively during a financial crisis. And then the last point I'm going to talk about is I don't really see a conflict between financial stability and the central bank's macroeconomic objectives. I think the problem is coming up with a sufficient set of tools that allows you to manage to both objectives. But I don't think the two goals of financial stability and monetary policy are really in conflict. So let me turn back to the first point. As we stand right now, the Federal Open Market Committee, and my comments are my comments, they're not those of the FOMC. I'm still on the payroll through Sunday. But to be very clear, I'm speaking for myself. The Fed has not made a definitive decision about whether to continue with the current floor system where you have lots of excess reserves in the banking system and you basically manage interest rates by the interest you pay on excess reserves, or return to the old regime, which was a quarter system where the Fed would basically put just the right amount of reserves in the system to equilibrate demand and supply, and that was the primary way by which you set interest rates. I'm going to argue that from my perspective, it's a no-brainer to have a floor system, not for all the operational simplicity that gives you, and Brian can also talk to that, but just from a pure financial stability perspective. Because in the crisis, we found that the quarter system really did impinge on the Fed's ability to take steps in terms of lender of last resorts that would have been helpful in dampening down the stress in the financial system. When you have a lender of last resort and the lender of last resort is drawn on, that adds reserves to the banking system. In a quarter-style system, you then have to turn around and drain those reserves to the system if you're going to continue to maintain control of short-term interest rates. So if you look through the history in the run-up to the financial crisis, there were a whole bunch of times where the Fed basically introduced something but didn't go in full throttle because they were worried about how this would affect the ability to conduct monetary policy. First example of this was the term auction facility, where the initial size was $20 billion. You know, $20 billion in a $10 trillion economy, that's probably not going to be sufficient. Another was the introduction of the term securities lending facility, which was a swap of treasury collateral for less liquid collateral, precisely because it didn't affect the amount of reserves in the banking system. And a third example, which Francesco certainly remembers very well, is the foreign exchange swap facilities were very much bound in size until the fall of 2008, when the Federal Reserve actually got the ability to pay interest on reserves. So why is it so important to have the ability to offer a broad-based lender of last resort without a limit on how much money is taken down? Because it's reassuring to people in the financial sector. People are much more willing to continue to lend and invest if they know that if things get worse, there's somebody behind them that's willing to take them out of their obligation. And so if you don't have an open-ended lender of last resort facility, this can cause people to get nervous a lot earlier, and that can actually contribute to financial instability. Now, with the floor system, it's true that the Federal Reserve's balance sheet in the supply and reserves in the banking system is going to be a lot greater. And as a consequence of that, there's probably going to be a lot less interbank trading of reserves. In the book, I think Francesco implies that this means that there'll be a large Fed footprint, and that could lead to less interbank activity. And I don't know, you didn't say it directly, but you sort of imply that that's a bad outcome, that somehow if we don't have this interbank activity, that's sort of a bad outcome. I don't really see it that way. I think we want a financial system that intermediates efficiently between savers and borrowers. And if we can do that without a lot of interbank activity, that's probably a good thing, not a bad thing. Because the interbank activity adds risk, it adds complexity. And so I think it actually can lead to a less stable financial system rather than a more stable financial system. So let me turn to the second point. So in the book, Francesco and Tuomas talk a lot about the diamondific model of good versus bad equilibrium. And I really do think that's a good way of thinking about things. But I would take it one step further than the authors do in the book. It's not just a question of luck or the central bank's monetary policy choices that determine whether you're in a good versus bad equilibrium, but it also depends on the regulatory framework, and in particular, the prudential standards that you set for capital and liquidity. In my view, one reason why the U.S. moved out of a bad equilibrium much faster than Europe was precisely because banks in the U.S. were forced to take capital. And the banking system in the U.S. was recapitalized much more quickly. And I think that forced capitalization of the banking system really helped push you from the bad equilibrium back to the good equilibrium a lot more quickly. My main point here is that firms left to their own devices may not choose to raise sufficient capital because they don't want to dilute their shareholders in the event that they actually don't end up in the bad equilibrium, that the world ends up in the good equilibrium. So that a lot of times you saw during the financial crisis where people were like, well, I could raise more capital, but I don't want to because this is going to hurt my shareholders, so I'm just going to hope for the best. If everybody hopes for the best and doesn't plan for the worst, that makes the worst more likely. And so you really do want to have something that comes in and forces firms to raise more capital, because it's not just good for their individual firm's survivability, but it's good for the system as a whole. Now, turning to the third point, the authors talk a bit about moral hazard potentially that's introduced to the system by aggressive central bank interventions. And there's no question that there are some moral hazard issues here. But I guess relative to the authors, I feel less constrained by moral hazard considerations, especially in the middle of a financial crisis. When the building's on fire, that doesn't strike me as the right time to be worried about, we better not put out the fire because this will cause people to be less careful in the future. I think the way to deal with moral hazard is long before the crisis actually occurs. You put in place regulatory standards with respect to capital and liquidity that are tough. That's the appropriate quid pro quo for aggressive central bank interventions when you're actually in financial crisis. So those are the tools I think you use to mitigate moral hazard. The final point I want to touch on is why financial stability has to be a central part of the central bank's mandate. As I see it, financial stability is a necessary condition for the central bank being able to achieve their monetary policy objective. So it's not one or the other. You have to have financial stability because if you don't have it, you're going to have an inability to drive the economy to where you want it to be in terms of employment and inflation. So I don't think there's a conflict between these two objectives. I think the problem is lack of a sufficiently robust toolkit. In the United States, the problem is a very simple one. We really don't have very good instruments in the United States to deal with financial stability issues independent from monetary policy. Doing macroprudential policy in the United States is very difficult because we have lots of different regulators. We have federal regulators, we have state regulators. So just coordinating how a macroprudential response would work in the United States is extraordinarily difficult. And in that regard, we do have the Financial Stability Oversight Council, but I'm really skeptical about whether they'll able to act in a timely way. Now, one option is to use the countercyclical capital buffer. That's something that the Federal Reserve has is in the Federal Reserve's bailiwick. The problem here, though, is a countercyclical capital buffer. This is raise bank capital requirements as you go through the business cycle, is that it might not be the right tool for a whole host of situations. And then there's also the question of whether you'd actually be able to do it in a timely way. So where are we today? I use my last minute and a half to talk about where are we today. I think the financial system is in much better shape today with much tougher liquidity and capital requirements. For the U.S., I have two concerns. The first concern is our willingness to engage internationally and to take appropriate responsibility for what is still a very much a dollar-centric global financial system. It's absolutely essential that the U.S. understand that they have that responsibility. And second, I remain quite concerned about our ability in the United States to manage the non-bank financial sector. Not only is this sector very large, but the Federal Reserve's lending authority to that sector has actually been constrained by the Dodd-Frank Act. A lot of the problems that arose in the last financial crisis really arose in the non-bank sector, and we don't really have a great tool set to address that. For Europe, I have really two concerns. One, I think Europe has been slow to strengthen its banking systems. The non-performing loans in Italy are a good case in point. And it took a long time for Europe to implement stress tests that were actually viewed as credible. And second, Francesco and I were talking about this earlier before, I do have concerns about the pace towards further European integration. I would have thought that once you had a pan-European supervisor for the major systemic firms, the next step would be pan-European deposit insurance. And I see no movement towards pan-European deposit insurance. And all I can say about that is I'm deeply, deeply disappointed. I'm waiting. So thank you.
Okay. Thank you, Bill. So next up is Brian Sachs, who is the chief economist at the D.E. Shaw Group. Brian also knows firsthand about monetary policy frameworks. He too was the head of the markets group at the Federal Reserve Bank of New York. He was actually Bill's successor, as well as much earlier in his career, a senior economist at the Federal Reserve Board in Washington. Brian, all yours.
Great. Well, thank you. Let me start with a word about Francesco. So obviously he held a critical seat on the ECB staff, and that was critical both before the crisis in terms of designing and implementing the framework, but then certainly for navigating through the crisis. He was a great resource. We had a lot of bilateral discussions. We also interacted at the BIS. So at the BIS, essentially major central banks around the world gather every 6 to 8 weeks and have a set of meetings, and he and I were both on the markets committee talking about a lot of these issues. And it was just interesting. The markets committee was a big table, lots of people talking. But when Francesco would speak, things got quiet. Everyone got really attentive. He commanded tremendous respect and on the committee and elsewhere. So, as for the book is pretty remarkable. It covers a very wide range of monetary policy issues, and it doesn't do it lightly. It's pretty thorough in terms of looking at what the research literature shows. It's very good at drawing inference from that literature, and that is not easy. I recently tried to summarize the literature just on the effects of quantitative easing, and it took me like a week. I noticed in your book it's takes up 3 pages, and then there's 297 other pages. So I think it was quite an effort, and it's very carefully done. It's very thorough. So really, congratulations on writing the book. I'll touch on the part of the book that talks about the monetary policy challenges that came up during the financial crisis. The authors focus on 3 points there, and they all really resonate and they're really important. So I'll talk about each in turn. So first, the authors talk about the fact that central banks had difficulty controlling policy rates during the crisis. And Bill touched on this, so we're going to overlap a bit. And this had to do with the expansion of the central bank's balance sheets and the liquidity it created, as well as just sort of unpredictable market dynamics. So Bill was running so Bill had a really hard time hitting the funds rate target.
Unlike Brian.
I had a perfect record, but my job was a little easier. We had already gotten to the zero bound at that point. So this was a substantial challenge, and the point I wanted to make, which Bill already made, was this was a challenge that really constrained policy choices at time, particularly choices surrounding the lender of last resort function, which was an absolutely critical function during the financial crisis. So as Bill mentioned, some of the liquidity facilities were rolled out more slowly than may have been the case without that constraint. They were designed in particular ways to take into account that constraint. And I wanted to make just a broader point that I don't think any of that is necessary. We should design a framework for central banks that is robust and flexible to the need to use the balance sheet in other ways, so that the central bank can decide what to do with its balance sheet, what to do with its lender of last resort functions, what to do with its asset purchases. All these things affect liquidity in the system, but we should have a framework where that doesn't compromise the central bank's control of overnight interest rates. So I think that's the general principle we should have. And that way, the central bank can make decisions about the policy rate, And separately, it can make decisions about what it wants to do with its balance sheet to achieve other objectives. Now, Bill mentioned a floor system, and that is certainly one approach to achieving this. I'm very much in sync with Bill on this, that I think it is clearly a better, more robust system than a corridor system. And actually I expect the Federal Reserve and a number of other central banks to stay in the floor system as we go forward. But regardless of whether it's a floor system or something else, that principle of having the ability to control rates and do things with the balance sheet at the same time is, I think, the guiding principle. The second point that the authors talk about is the relationship between the policy rate and financial conditions and ultimately the economy, and the extent to which that relationship broke down in the middle of the financial crisis. The way the authors describe this is they, many times in the book said, well, the transmission mechanism was clogged, or the transmission of monetary policy to financial markets was impaired. I think I would probably use different language than that. Basically, so essentially, the Fed and most central banks control a very short-term interest rate, and that interest rate by itself is not that important to the economy, right? What's important to the economy is a broader set of financial conditions where firms and households borrow. What matters to the economy is the price of assets and determining people's wealth, and all that's related to the short-term interest rate, but so it's that mapping between the short-term interest rate and these broader financial conditions that matter. So what I would say was that policy changes in the crisis still had the same effect, or maybe even a larger effect, on financial conditions, but the central banks were fighting a massive shock. They were fighting a massive shock that was tightening financial conditions. At the same time, they were trying to loosen them. And this was an incredible, nonlinear, unpredictable shock. I mean, the best economic staffs in the world, both, couldn't anticipate what was going to happen in financial markets, and also couldn't anticipate how damaging those financial market developments would be on the economy. So this was a tsunami hitting the financial system. No one had ever seen anything like this. And it was policy trying to offset that that mattered. But again, I think policy was sort of doing its job offsetting that, or trying to do its job, and it was just facing this big shock. Now you may say, well, why does this matter? Like, they sound like the same thing, like, whether policy wasn't working or whether policy was working but was just facing a big shock in the other direction. Well, it does matter, because if policy's not working, then there's no reason to use it. If policy is working and it's just fighting a shock, you want to use it, and you want to use it early, and you want to use it aggressively. And I think that was the lesson from the crisis. It's easy to underestimate the negative effects of a financial shock. There's great benefits to being aggressive and early in reacting to it. The third point that the authors made was that policy was constrained by the effective lower bound. So there's a limit to how low interest rates can go. We used to think that limit was 0. I'll come back to that in a second. But for a variety of reasons, including the ability to hold hard currency, there's a limit to how low nominal interest rates can go. This constraint on policy was a major issue, a major issue in the financial crisis. So in March 2009, at the peak of the crisis, the Federal Reserve staff prepares documents ahead of the FOMC meeting to inform policymakers about their upcoming policy choices. And that, in the Green Book at the time, they had a simulation that showed what the policy path should be to return the economy to its objectives. That policy path had the overnight interest rate, the federal funds rate, going to minus 6.5%. So that shows you the depth and the intensity of the negative shock. Now, of course, we can't take the nominal interest rate to minus 6.5%. So what the FOMC did was it began conducting asset purchases and taking other steps to try to fill in for that accommodation that it couldn't achieve with the overnight interest rate. But it didn't do enough. First of all, it did less than what the staff said would be needed to replicate that minus 6.5. And not only that, I think at the time the staff was overestimating the effects of these asset purchases. So So it didn't do enough, and we had a very sluggish recovery. But that's all driven by the fact that you couldn't use your primary policy instrument as aggressively as you wanted to. And I think this is the single biggest issue facing central banks going forward. As discussed in the book, we believe that equilibrium interest rates, the interest rates that would be normal in the economy that's operating at full employment and with stable prices, those have come down a lot for a variety of reasons. And that means when bad shocks happen and central banks ease, we're very quickly going to hit the zero bound. And I think this is an outcome that is underappreciated and underpriced in markets. And really, if you look out any given year, out on the horizon, what are the chances we'll be stuck at the lower bound? I mean, I would guess they're more than 20%. So this is an issue that's going to continue to constrain policy. Now, the book does a nice job describing how central banks have probed that lower bound and moved rates into negative territory to some degree and what the experience with that was. And I think there's been some success in that regard. But this is not a perfect policy, these negative rates. There's a limit to how far negative they can go. They're sort of done in a tortured way where central banks sort of hope that, well, depositors won't get negative rates, but bond investors will. And it's just a little complicated and certainly imperfect. And so really, I think, over the next 20 years, I mean, society needs to figure out if negative interest rates are okay or not. And if they're okay, and if deeply negative interest rates are okay, we could, perhaps move in that direction. And if not, then we're stuck in a world where we're going to use QE, asset purchases, and probably have more sluggish recoveries than otherwise. So that's it. Overall, I mean, the book talks about all these topics in great detail and many others. I think it's going to be a tremendous resource. Thank you.
Thank you, Brian. And our final commenter is Jens Nordvig. Jens is the founder and CEO of ExAnte Data, a data analytics and advisory firm that is focused on international macroeconomic and financial strategies. He's had a long career as an economist and a foreign exchange strategist at Nomura, at Goldman Sachs, and at Bridgewater.
Thank you.
It's yours.
Yeah, so I'm the only person who's not a famous central bank person here. So I'm going to try to offer a little bit more of a practical perspective because my career has been involved in forecasting monetary policy and forecasting currency movements. So that's the angle I've had. So first, just very briefly, a couple comments on the book. So I really love the fact that you and your co-authors put a lot of effort into making these long-term charts. Like when people write these books, it's often the case that they're very focused on the commas being put in the right places and the wording being very good, but I think these pictures actually really make a big difference, and you have very, very long charts, and I think that really is a great perspective. And then on Francesco as a person, we've had a lot of discussion about monetary policy over the last couple of years. And one of the things I like about your approach to analysis in general is that you're a very balanced person. There's often people who have like a very kind of ideological, like religious view sometimes even about certain things. And I think you generally have a very pragmatic stance. And that's one thing I like about it, and that's why I was very happy to come here today. So I want to make 5 quick points. When I look around the world, different countries have different forms of inflation target, but as you mentioned in the book, like the inflation target is like the far dominant regime. But some countries are more precise than others. So the ECB does not have a point estimate for its target, which is a little bit unusual. Other countries do, and one example that actually a lot of investors have been focused on in recent years is Sweden. So Sweden is a country where they have essentially a 2% inflation target, and recently they've had inflation incredibly close to the target, like roughly 10 basis points below for a sustained period of time if you average it out. Just it's like really just rounding. They've had strong growth in the economy, and then over the last couple of years they also started to have a currency that has weakened so much that it actually started to be a debate in the country about, okay, is the central bank doing the right thing? So this is an interesting situation and a specific example of inflation targeting where you have this combination of a central bank that is incredibly close to its target, the economy is seemingly doing well, and they still have rates that are deeply negative, more negative than in the ECB's case. So I think that raises the question about whether there's sort of a trade-off between having a tiny inflation miss that could be rounding, and then all those potential negative side effects of having these extraordinary monetary policies. That's certainly something I've been thinking about. And in the central banking world, I think there's often an extreme focus on the credibility of the target, and I understand why that focus has to be an extreme. It's obviously very important, but it does seem to just totally dominate all these other considerations that I think when you're that close to the target could be relevant to put into the equation. So that was the first observation I want to make. The second observation I want to make, and this really, all these quick points I want to make have to do with, okay, what should be the framework for monetary policy in the future. So there are countries around the world where Japan is probably the best example, where it's just been very difficult to get to the target. They also have a 2% target. And it is something I've been thinking about a fair bit. So in the book you comment a lot on the breakdown between monetary aggregates and the inflation mechanism, referring to Friedman and so forth, and Japan is obviously an extreme example of that. But I also wonder whether there are some kind of structural forces in the economy that might have something to do with what you call equilibrium inflation level. Like, the more I visit Japan and trying to understand what's going on with the inflation developments, I have this suspicion that there's something with demographics that impacts certain prices, for example, cost of housing, and that creates a kind of influence on inflation. And that, I think, is something that could be relevant to take into account. And there's very little discussion about what the specific numerical target for inflation should be. In the academic literature, that you often have this thing where you refer back to something that's generally accepted, and then when it's generally accepted, then you don't have to discuss it very much. And it's a little bit the same with the 2% number, that it's generally accepted that that's what most people go by, but why is it exactly 2%? Maybe it should be different in Japan. I think that's something that warrants attention, especially given the structural changes that are going on. The third point I want to make is, we can use Japan as an example again. And this has to do with going back to some of Bill's comments about financial stability. It seems to me that the Bank of Japan, I wouldn't say they have a dual target, but they've started to really pay attention to what's going on with bank profitability. So since September 2016, they've made some tweaks to their monetary policy framework, and it's pretty clear that they're really watching profitability in the bank sector. And I think their experience with negative rates is one where it actually proved to be pretty damaging for bank profits and therefore the transmission mechanism monetary policy, and therefore they've learned that in their situation it is not something that they can actually push further. So bank profitability is certainly not something you normally see in a Taylor rule or anything like that, but it could be the case that the effects of this should be embedded somehow. And essentially the point there is that the highly negative rates could have a significant cost, and that could also mean that even if you are in a situation where there's significant gaps in the economy, as you have in Japan, you still have a big gap relative to what their inflation target is. It actually means that you don't just max out your tools, right? You actually stop before they will sort of be maxed out in a mathematical sense. So I think that's a key point, and really, like, research on what the sort of optimal limits of the various policy instruments are country by country is really important for defining what the best framework is going forward. And then I want to make 2 points that pertain to kind of the stuff I do for a living, which is more to do with currency forecasting. So FX intervention is a big piece there, and that has to do with international cooperation. And what if the inflation target requires that you get involved in the currency market? So that's something that we've typically not discussed for major economies, because there's been a consensus within a G7 context that that was a no-go area to some degree, at least for a while. What I wanted to raise is that if you get too obsessed with the inflation target, and we can use Sweden as an example. Again, I'm not from Sweden, so it's not because I have any specific attachment to the country. If you need to get involved in that game in order to generate the next 10 basis points of inflation that's going to get you to the target because you were very close in the first place, is it really worth the cost? So that's the calculation they've done in Stockholm, and they thought it was worth going down that route and at least putting that instrument really on the table. But I wonder whether it's worth it in a world where we have a very challenged situation around international cooperation, and where that could generate some pretty significant backlash. And that brings me to the final point. So we are in an era here where there's some totally new things going on in terms of trade tensions. We've had to bring out some of the very old textbooks about how to analyze tariffs that we didn't really use for a couple of decades. And we're also getting to close to a point where this kind of populist term, currency war, is actually becoming relevant. Like we've had the US president complain about what the Chinese have been doing about their currency. He even complained about what was happening to the euro. So this is a much more sort of high-stakes game that has been for a while. And we even have the situation where President Trump is very vocal about not being in favor of a strong dollar. He regularly criticizes the Fed for hiking interest rates. And there's even a debate now about whether the United States could actually conduct currency intervention to weaken the dollar to back up these wars that we've seen so far. So that technically would sort of be something that starts at the Treasury, because they have a pile of money that's supposed to be used for this purpose. But it's normally something that is backed up by the central bank as well. So it's something that typically has been done half and half was the rule over the years. And that really brings into question the central bank independence if you can have a situation where severe global currency tensions create, even in the major currencies, this tension around currency intervention, and that potentially could be very problematic for the Fed or other central banks that try to focus on their objectives and then have this, what should we call it, obstruction from this other goal at the same time to deal with. So those are the points I want to make, some very practical ones, and I think you touch on this specific thing in your book as well, towards the important last chapter of the book. Thank you.
So thank you all three. Francesco, that's a lot to respond to.
Indeed. Well, let me start with thanks to the three participants, and of course my thanks go a bit further than just for what they said today. Brian, in a way, bears some responsibility for this book, in the sense that he sent me an email, what do you think about writing a book together? And I said, yeah. And then he said, well, maybe I've had second thoughts. And then I...
and then he mails me a book.
and then in any way, I was so keen to do it that I found another co-author to do it. And of course, I mean, Bill and Jens, we, as I said, we had so many exchanges over the years that I don't really know anymore what is really my ideas and what I just borrowed from her. Let me also thank Trish, to whom I went when I had some doubts about the situation in the US, and to Debbie that helped me on filling the gap of knowledge about the Fed, because of course both authors are connected to the ECB, but we wanted to write a book that would also talk about the Fed. Trish said that we are inverting the usual order, and after these comments, I wonder whether we should have not inverted even further, so that they would have commented on the book before I would write it.
Okay.
So that it would have been a better book, so to say, if we would have done that. But okay, it's now too late. Maybe if Oxford University Press would want to have the second edition, then I would be able to fully take into account the comments that I received. But let me just pick up, as Trish said, I mean, many issues were raised, all very important. Let me pick up a few. The first one is about, Bill touched upon that, looked at that, is relationship between financial stability and price stability, monetary policy. And there, my basic argument is that the crisis brought onto central banks this task of achieving financial stability that, as I say, was the neglected child. Yes, central banks knew they had something to do about that, but they didn't really put it on the top of their preoccupation, and even they thought, well, if we achieve price stability, in principle, that should be enough to achieve financial stability as well. And this was not the case. The financial stability responsibility fell on the shoulders of central bank by nearly force of gravity. I mean, yes, it was not clear that they had to care about this, but who else can do that? I mean, central banks are the only ones who have a holistic view of the financial system and the ability to do something about the financial instability because of the ability to produce liquidity and to manage interest rates. And then I say, okay, we are in a situation where there may be two conflicting objectives for the central bank, and of course an interesting discussion is whether we are in this situation now, where we would like maybe to increase interest rates because of financial stability considerations, and maybe because of banking profitability considerations that has something to do with financial stability. So we would like to do one thing with interest rate for financial stability, but we cannot do it, or we are constrained in doing that, and maybe the case of Japan is particularly significant here, because of price stability objectives. So the dilemma that did not really appear during the crisis between using the interest rate for price stability and financial stability is maybe here now, and we cannot exclude that it may present itself quite strongly in the future. So we were lucky during the crisis. We had no dilemma, but the dilemma could come. And so the hope, of course, is that we would have two objectives, price stability and financial stability, and that we would have two tools, interest rate and macroprudential policies. But I think Bill clearly said that macroprudential policy is more a hope than a reality. I mean, we are working a lot, which is good. I mean, a lot of investment is being devoted to making macroprudential policies more of a tool that can be properly used. But we lack a lot of empirical information. We even lack some theoretical information, and we are not at all convinced that the institutional framework that we have on the two sides of the Atlantic to carry out macroprudential policies with the Financial Stability Oversight Council here and the ESRB, European Systemic Risk Board, in Europe are adequate for the purpose. So we hope we would have macroprudential that would deal with the dilemma situation, but we are not sure. And so given that I am, or I was, a very cautious central banker, I think of what to do in case a dilemma would appear. And here my solution, and if any of you will look at the book, will agree with me that the third part of the book, the one I look into the future, is the weakest part of the book. In that part of the book in which I look at the future, I try to find a way to deal with this problem. And the imperfect solution I come up with, but I could not get a better one, is that if the central bank finds itself in a dilemma situation, it should first of all either do whatever it can on the macroprudential, if it has the macroprudential tool, or go to the macroprudential authority and say, please do something because I have a problem, I have a dilemma. If this does not solve the issue, the central bank, in my view, should go to the principal, to some parliamentary committee, and say, listen, I mean, I have one tool, the interest rate, and I don't know to which of the two I should assign, financial stability or price stability. You are my principal, you please tell me. And Parliament or whomever would say, okay, you put this or that first. The central bank goes out and does what it is said to do until the time that it says, well, I think that all is clear now. Financial stability is no longer in contradiction with price stability. It goes back to its principle and says, alarm is over, I can return to my normal situation. So this is part of the relatively small changes to the central banking model that was prevailing before the recession that I think are needed after the Great Recession. I said relatively small because this would require a change of the Federal Reserve Act, a change of the Maastricht Treaty. So I mean, it's not that we are saying that it would be easy, but with respect to some radical proposals that are going around, one radical proposal is forget about central bank independence, make the central banks again a part of public administration, maybe a little more pompous because central banks also, when they were just a government department, had some better image, but basically just a part of the government, or just get back to the narrow central banking model that was prevailing before the crisis, no financial stability responsibility, just price stability to be pursued with the interest rate. I don't think that these radical choices are possible. Therefore, in relative terms, what I propose is minor. On moral hazard that Bill raised, moral hazard is part, necessary part, I would say, of the economy. I mean, it would make no sense to think of eliminating moral hazard, then it would make sense to eliminate insurance companies. I mean, insurance companies are managing moral hazard every day. And my solution to deal with moral hazard, it goes in the same direction. I mean, insurance companies use deductibles. They don't cover the entire. They don't cover the entire risk. They cover only part of the risk. And I think that central banks should do the same. And I think that when we priced the swaps, we did exactly that, because we priced the swaps between the Fed and the ECB in a way that they were cheaper than the market price that was prevailing in a bad equilibrium situation. But they were more expensive than they would have been if we would have had a good equilibrium situation. So they were somehow intermediate, and I call this Diamond-Dybvig pricing. So part of the pain has remained on banks because they are paying more than they would be paying if they were in a good equilibrium. But part of the pain is taken away by the action of the central bank. So I say moral hazard, yeah, it's unavoidable, but we have to manage it, and we manage it by means of deductibles. In the European Union, the deductibles applied to sovereign are that the central bank should never help them without a macroeconomic program, an adjustment program. And that, of course, puts some of the pain on the central bank. Let me come to a point that Brian raised, and the fact that the interest rate has not been enough and may not be enough to pursue the objectives of the central bank, and this needed to be complemented by central balance sheet management, and may need to be complemented with that going on in the future. And of course, this is a discussion that is very close to the secular stagnation story, because if we are in a period of secular stagnation, we are going to have the natural rate, the R-star rate, very low, and so there will be little room to reduce rates in case of a recession. I think typically rates were reduced by 5% in a recession. If you start from 3 or 4%, you just have no room to do that. So you may be forced again to use the balance sheet, the central bank balance sheet, to complement what you cannot do with the interest rate. And this, in my view, and maybe here I have a kind of a bit of European bias, a bit of a Bundesbank bias, this creates a problem in the sense that it blurs the border between fiscal policy and monetary policy. So I'm not at all saying that central banks did what they did on quantitative easing, and in particular on purchases of government bonds, to help the funding of the government deficit. They did that for monetary policy reasons. But the situation is that more or less the Fed and the ECB, the Bank of Japan is even higher than that, and the Bank of England have about 1/5 of the total stock of government security in their balance sheet. And this inevitably blurs the border between fiscal and monetary policy. And to my view, this is a problem. So yes, we may need to use the central balance sheet again, which means purchasing a lot of government securities, but this is something that we should do just as ultima ratio. We should be very sure. So here my proposal, again, I don't like it, but again, I could not find anything better, is that in order to use your central bank balance sheet as a complementary monetary tool, you need a special voting, special majorities. When I mentioned this to Jean-Claude Trichet, that was discussing my book at the Banque de France, I saw a lot of grimace on his face. But again, that was my way of combining the possible need to use it with the fact that this has got this unwanted effect of blurring the borders between the two policies. I'm glad that Jens appreciated that I have long time series, in particular, as I said, there is one that starts in Babylonian times, and there is an attempt to have interest rates over the last 5 millennia, and that was, of course, I thought that was kind of funny, but I also thought that this would shed some light on the issue of secular stagnation, because if we would find, as I did find, that it's very unusual that interest rates are at nominal interest rates are 0, and even less that they are negative, there is some support for this secular stagnation, because secular stagnation basically said this is quite exceptional, this is not the aftermath of the crisis, or this is something a bit more fundamental than this. If indeed you find that it has never happened over 5,000 years that you have had interest rates so low, this is some support of the secular stagnation. On Jens' intervention, the point I would like to take up is the 2% and the obstination to pursue the 2%. And now, let me be very frank. 2%. There is no particular reason why it's 2%. I mean, it's not that 2% is the optimal level of inflation, and then the optimality of inflation just comes down very quickly, and it's much worse if you are at 3% or at 1%. I mean, I don't think you can prove that 2% is so much better than contiguous rates. I think you can prove that it's much better than far away rate, but not. So there is an element of convention in 2%, but conventions are not irrelevant. I mean, I think that about 1 billion people in advanced economies have been convinced that 2% is the rate of inflation that they should use in their own economic choices. So there is a kind of hard wiring into the behavior of the economy, this 2%, which you can say with a straight face is the closest empirical approximation to price stability, because we know that there is a bias in measuring inflation. So 2% measured inflation is probably as close as you can get to price stability, 0% inflation. And this, to me, the value of this convention is what has made the entire advanced economies to concentrate on this 2% with little variations. I mean, I think Norges Bank had the 2.5, but now they're moving it to 2%, talking about being very precise. And the ECB has closer, but basically 2% is a kind of universal number, which takes its value, in my view, from a convention. And just a little addition here. One proposal was to move from inflation targeting to price level targeting. So I've carried out a little search on Google on the frequency of the term inflation and the frequency of the term price level. And basically the frequency of inflation is 5 times as high as the frequency of price level. And what I infer from that is that it would be much, much more difficult to transmit an objective of the central banks in terms of price level, because people would not know what you're talking about. Inflation, people understand what you're talking about. Price level, people basically don't understand what you're talking about. And communicating on something that people don't understand is much more difficult than communicating on something that people do understand. I think that this is one of the reasons why I would not be in favor of price level targeting. You will allow me at a certain point in time to do some publicity to my blog and my Bruegel page, but that's what I wanted to say for the time being.
Okay,
Yeah.
thank you. So we'll take a few questions, and you still could take a few minutes at the end about your blog. All right, so questions. We have somebody with a mic, I think. Yeah. Oh, yeah? Okay, we have one here and one here. So why don't we take two, and then we'll take a couple back there after. And could you identify yourself, please?
Sure. Thank you so much. Constance Hunter. I'm a SEPA 94 and chief economist at KPMG. So I have read a lot of the work that's been done about the analysis of where rates or how much rates would need to fall should we have another recession, and the amount of cushion we have, both fiscally and from the monetary side, to address the next recession. And I know that as you mentioned, the 5 percentage point cut of central bank rates is what's been historically the norm. But shouldn't we understand that in its relative context? Because that was relative to a growth rate that was above 3%. That was relative to inflation that was above 3%. And is that the empirical number of basis points the thing we should be focusing on, or should we focus on it relative to the strength of growth and the pace of inflation?
Okay, so I'll have two. Francois, you're next. And then we'll
Thank you. François from Banque de France here in New York. Just two questions, if I may. One for all the speakers. Basically, one of the points which I feel is underneath this discussion is also the question of the transparency of the central bank and in its action, and whether this transparency has changed since the crisis. Obviously, it has. Should central banks be fully transparent? Should they still need some form of gray area to make their action more efficient? Knowing that the more we go toward transparency, the more difficult it will be to go back, should it be necessary. The second question may be more targeted and maybe for Bill. You mentioned the fact that maybe having an active interbank market is not needed, or not needed to the extent that we could think of. Going forward on this point, what do you think of this TNB initiative, which is all over the place these days? Thanks.
Okay. Why don't we take these, and then I've got two more back there in the middle in just a minute. So, please.
Well, on the question how much we need to reduce interest rates in case of the next recession, of course, you say we don't really know. I would say that from a prudent policy point of view, you would like to have as much petrol in your tank as you needed in previous occasions. And of course, I mean, if you read my book, you would find a lot of times where I say, well, I don't know, I'm not so sure about this. There are risks here. The most prudent way of doing things, in my view, is cease of that. And again, this, I think, reflects 40 years of central banking. And if I was an academic, I would be much stronger and much more determined. So my answer I think it would be imprudent to think that even if we start from rates of 3%, we would be able, in all cases, to react to a deep recession. Now, on transparency, I think maybe you could come in, or Brian or Jens.
Okay, I mean, on transparency, my view is very simple. The Fed sets short-term interest rates. That affects financial conditions. Financial conditions affects the real economy. So why wouldn't you want to have transparency so people understand how the monetary policy regime is likely to evolve? Because that's what drives financial conditions. So I'm very much in the transparency school rather than the Wizard of Oz school. That said, you can't, there are limits to how far you can go in being transparent. If we had cameras at the FOMC meetings wouldn't be very interesting. There wouldn't be a lot of exchange of information. So there's a limit to transparency where it starts to inhibit the conversation and the debate. I had a question directed my way on the narrow bank. I don't really have much to say about the narrow bank in the sense that the narrow bank, this is a proposal to basically set up a bank that just invests in reserves, bank reserves. And so it's completely safe because that's the only asset it has. So you'd have these very, very safe narrow banks. The problem with the narrow bank is the banking system isn't really designed to just have safe assets for people to invest in. It's designed to intermediate funds between savers and borrowers. So you could sort of argue that a narrow bank actually a little bit undercuts the purpose of what a banking system is all about. It also raises a lot of other more political economy issues in the sense of, the Federal Reserve's ability to pay interest on excess reserves. Who else could set up a narrow bank? I mean, in principle, if you allow one narrow bank, you could have any large corporate entity could set up a narrow bank and just have their assets moved into the narrow bank. It also probably would have some implications for the conduct of monetary policy, how you actually would be able to conduct monetary policy. So I think the issues are quite a bit more complex than what some of the debate has been to date.
Any other comments? No?
Okay. So we had two questions back here in the middle. Yeah.
Hi. Thank you for your insight. My question is to all. Housing is very important to the economic. So mortgage market is still very, depressing. So my question for you is what would be the future of Fannie Mae, Freddie Mae? Thank you.
I think we all wonder about that.
We all wonder that, yes.
So good morning, thank you. Michelangelo Quaglia, student here at SIPA. My question is why we still don't have a transparent lender of last resort in the Eurozone, given that three main points. The Greek crisis is far from being defined as a success. So the Troika or the management has been kind of painful. The second point is the GROW and others show how inflation is not a real problem in financial crisis, and moral hazard is still there when you're considering lending to banks instead of sovereign. And I guess the third point is how important would it be to have it now, given that the political environment is changing strongly, both in the US and in Europe? Thank you.
So,
That's for you, Francesco. Huh?
yeah. The second question is definitely for Francesco. You don't have to answer about Fannie and Freddie.
Yeah, well, no, I mean, I have an answer.
Oh, good, please, go.
About not doing Fannie and Freddie was the polar star in thinking about doing something in Europe for mortgages. I mean, don't do like Fannie and Freddie. That was the very simple kind of maxim that we had in Europe. I mean, this is the negative example to follow. I mean, now on ELA, I think that the situation of ELA has not been and is not fully satisfactory because there is a lot of ambiguity there. The ambiguity results from the fact that ELA is in principle a responsibility of the National Central Bank. However, the Governing Council has to not object to it. So has a kind of veto. So this is a legal situation. And the de facto situation is that the Bank of Greece, just to be, would have never been able to lend, I think it got up to more than 100 billion euros to its bank if it did not have the euro system behind it. I mean, there was no capacity in the balance sheet of the Bank of Greece to do anything like that. So in legal terms and even more in practical terms, ELA is a Eurosystem responsibility, which has implications for financial stability, has implications for monetary policy. So I think that it should be made clearly a responsibility of the ECB. And I understand that there is some move in this direction. But I think the situation started that there was not even a single pricing for ELA. Each national central bank could say, well, I apply this or I apply that, and there was no, and of course we moved towards at least a single pricing. But I don't think that this is enough. I think that it should become a fully fledged Eurosystem activity. You mentioned the Troika. In the book, I say that one of the negative effects of the crisis is that the ECB became a member of the Troika, that had to go in different countries and tell how long shops should be open and what you should do with your pension system or what you should do with your labor market, which is nothing on which the European Central Bank has a special expertise and even less a special responsibility. So I think that participation of the Troika was probably a necessary evil, not to be repeated.
So I'm going to, moderators don't usually do this, but I'm going to make one comment about housing and Fannie and Freddie, since one of the questions is there, and for better or for worse, it's a topic on which I've done some work. There's a very long history of having grave difficulty doing housing finance reform in the United States. It's a legislative responsibility. I call it the third rail of American financial reform. And so in that sense, the lack of progress and coming up to an alternative for Fannie and Freddie, it is not surprising, but it's obviously extremely unfortunate. Going back to their old form is systemically risky. That was predicted before the crisis. Unfortunately, it came to pass, and if it went back that way, I think it could happen again. So a new structure, in my personal opinion, would be wonderful, but it's not going to happen without legislation. So I think we probably have time, since people look pretty patient and not too many folks have had to run off to class, for a couple of more questions. I had one here in front. Was there another? Yeah. Okay.
Hi, Daniel Moss, columnist with Bloomberg Opinion. I wanted to follow up on the question over there from Constance Hunter. You probably are familiar with Claudio Borio's commentary in the introduction to the latest BIS quarterly report. He talked about how markets, particularly emerging markets, are looking fragile and bemoaned that there really isn't enough, to use your term, gas in the tank if the central banks have to cut again aggressively. And Brian, you kind of got to that point a little bit as well with your conversation about the zero bound for a long period of time. Is Claudio sort of whistling past the graveyard here? I mean, do we have the ammunition for the next downturn? US expansion is already closing in on the longest we've had. Thank you.
Thank you. Giovanni Mainoni from Banca d'Italia. I have a question on the transmission mechanism of monetary policy. I'm not sure whether this is, what extent is that in Francesco's book. But the question is the role of the interbank market. It's a question which is sort of, Bill Dudley just alluded in his remarks. And the question is whether this plays a different role, perhaps, in the United States and in Europe. And, the implication has to do with the final size of the balance sheet sort of normalization of the two institutions. So I wonder whether, both Bill Dudley and Francesco may have some answer or comments on this.
Now, on the observations of Claudio Borio, I think Claudio is one of the most quoted economists in my book, and I do share much of what he says. but I'm not sure that he would share much of what I say. In the sense that maybe we have a different appreciation of how important it was for central banks during the Great Recession to do new things, to get out of what they had done. And basically, I mean, I think that the common experience is that we were fully aware that we were doing things that were written in no textbook. I mean, we couldn't find. We had some Japanese experience ahead of us. But basically, I mean, we had to invent as we went, and I think that Claudio would find, I mean, I don't want to speak for him, but I think that he would find that we did too much, and we keep doing too much. I think that this is his main point. On the interbank market, and of course this is connected to the story about the corridor approach or the floor approach. Well, one thing that I say in the book is that this problem will become topical for the ECB maybe sometime around 2030 because the size of the balance sheet is so large that it will take a long time. The Fed, of course, is probably closer. Maybe I've seen I've seen the latest Federal Reserve Bank of New York. I think they talk about 2021 as time when maybe the balance sheet would have approximated the new normal. So just to say that particularly as far as ECB and even more for the Bank of Japan, the discussion between the floor and the corridor, we have time to discuss, to accumulate the new ideas, new evidence. On the importance of the interbank market, and of course this connects to something that Bill said. I don't know, I have a kind of sentimental attitude towards markets. I like markets. So if a market disappears, I somehow feel uncomfortable. But I admit that this is sort of not so strong an argument, and so I look forward to the next 10 years to conclude on this. But maybe I can say something a little more specific to a point raised by Bill, and this is why is it so good to have abundant liquidity for financial stability purposes? And let me put the case as follows. The time when you need abundant liquidity is when you are in a stressed situation. You don't need huge amount of central bank liquidity in normal condition, either for financial stability or for payment purposes. So this is the first statement. The second statement is, just because we were so inventive during the crisis, we managed to provide very abundant liquidity very quickly when it was needed. So why do we want to do something that is needed in wartime, in peacetime, if we know that we can do it very quickly in war times? I still remember when September 11 came. I don't remember whether we established the swap with the Fed in 24 or 48 hours. So it was very quick. So why do we need to have this constant, so abundant liquidity provision when we can create it quickly when it is needed? And of course, the experience that we have accumulated will not be forgotten, and our successors in the two central banks will be able to dust off and repeat what we did. So, yeah. Another question mark.
Can I just add something to that? So we'll have a little debate here.
Yeah, sure, please.
I think the key question is whether people know that it will be forthcoming or not. If you have uncertainty about whether something will be forthcoming or not, that creates uncertainty that pushes in the direction of risk and panic. So I think the real question is, do people know with confidence that something will actually be forthcoming in a timely way or not? If they don't know that, then I think you have a problem.
And there's also just the broader point. I mean, central bank reserves, I mean, it's in some ways the ultimate asset, right? It's used for payments. It has no risk. It's completely liquid. Even if we say, well, it can be launched and provided as needed, I mean, there are benefits to having ample liquidity in normal times. And I would argue it's hard to see the social value of creating scarcity in this asset that sort of is the ultimate asset.
It's essentially free.
Yeah.
Sorry about that.
Coming back to the question about capacity, to capacity to ease, I wasn't just trying to allude to it. I mean, I was trying to state it very clearly that I think this is, the most significant issue facing central banks is their inability to ease sufficiently in response to large negative shocks. So here's what I think we know. I think we know.
I'm not trying to sabotage you, Brian. I don't know.
That's for emphasis, right?
When we get to zero bound, we know central banks have asset purchases, and we know they will likely use guidance. And I think from the research shows both of those are effective. They're both helpful. They can make financial conditions more accommodative. But they're not the best policy instrument. They're not the primary policy instrument. Asset purchases have to be very big when you're operating in liquid markets to have effects. Guidance is going to be useful, but only useful when the markets or the public is misunderstanding the central bank's policy approach. So they both have limits. They're not the same as the ability to cut the policy rate. Essentially, I think, for large enough negative shocks, policy is going to be constrained, and we're going to have a situation where those tools are used, but the result is going to be more sluggish recoveries and more difficulty getting the right amount of stimulus into the system.
So, yeah,
I'll just make a quick observation on this sort of EM tension point that Bori has been referring to. Like, okay, you can view that as a shock that's hitting that requires some kind of response, and then we can discuss whether the ability to respond is there. But I think the question is kind of also a little bit what direction the causality is running here. So we have some tightening finally happening in the US and in Europe to some degree after a long, long period where we were trying to go in the other direction. And if you look at what's going on with capital flows, like one thing that is very obvious is that EM has been incredibly supported by liquidity out of Europe. Just dissect the numbers, it's almost all the debt flows into EM came from Europe. And now we have tapering, and those things are linked, and therefore the EM debt purchases from European investors are much, much lower and actually turning negative. So I think what you're seeing now is a function of the reversal of these unorthodox policies that went on for a long time. So that's what's causing the EM tension to some degree. And then, okay, that specific shock that actually will have to be dealt with by the EM countries themselves. So that will not be the shock that, for me, tests the major countries' lower bound again.
Any other comments?
No, I just, as I said, I just wanted to have my publicity, which is here. So you can follow me on Bruegel. You can follow me on Twitter. You can follow me on my blog. And given that the audience is larger today, I just seize the occasion to increase the clicks on my on my internet publication. And apart from that, I just thank you very much, Trish, for having organized that. Thank you very much to the discussant. Thank you very much to the audience. I really enjoyed and appreciated having the chance to discuss not so much my book, but the issues that are dealt in my book, which I think are pretty important. So again, thank you very much.
Thank you very much.